we're seeing is the job finding prospects have slowed down pretty substantially. But what the important thing is we're not really seeing layoffs pick up. So it is a sign of a cooling labor market, which was largely consensus kind of heading into this year. I think that should be the sort of message, is that the labor market should hold up, but it is certainly a lot cooler than where it's been. The thing to focus on from here on out is to what extent immigration ends up putting significant downward pressure on job gains. So our forecast we just put out for next Thursday, the payroll reports on Thursday next week, is for 130,000, which is a decent number. Granted, we do think it will ultimately get revised down below that, but at least on first print, it should be decent.
So how do we think about that immigration issue? The southern borders effectively been closed. How does that flow into, I don't know, the farming industry, the construction housing business, which I know employs a lot of immigrants? How does that work?
Yeah, that's going to be a challenge. And I think it's not even just about the border being closed. The flows of immigration have slowed down quite a bit since the sort of the beginning of the Trump administration.
Yep.
And even at the end of the Biden administration, they did start to slow down the flows of immigration. What's going to be important from here on out is the visa expiration. So there is about 1.5 million to 3 million people whose visas are going to expire because these are discretionary visas. The administration has the ability to end them over the next 18 months. And this is going to be the real impact to the industries that you cite: farming, construction, leisure and hospitality in some areas. Yep. This is where it could start to become a real tightening, and the companies might have trouble finding labor again.
Brilliant. Let's crystallize this to the jobs report on July 3rd. It's the first time I've looked at the numbers, folks. Stephanie Roth, of course, living this. Last time around was 139,000, well under 150, well under 200. The statistic now is 116,000. That 116,000 isn't the same as 116,000 5 or 10 years ago, is it?
No, it's not.
What's that delta?
So the way I think about it is the job number versus sort of the break-even rate. The break-even rate meaning kind of the steady state that would be sort of neither tightening nor easing up on the labor market. Today, that's around 75,000 based on our estimates. Wow. But 2 years ago, that was double that. So that's why we were able to sustain really high job gains without really seeing, a significant tightening in the labor market, because we had all of this flow of immigration. That is largely cut off, and that 75 might even be slightly lower than that, realistically.
So is there a unemployment rate number that gets the Fed's attention, do you think?
Yeah, I think in two directions, right? So the Fed's own forecasts are that it could be 4.5% by the end of this year, and they kind of expect it to stay there through next year. So if you get to 4.5% by the fall, certainly would be grounds to be cutting. But there's a chance that this whole immigration dialogue that we're having has the opposite effect on the unemployment rate, because it is tightening the labor market in those blue collar industries and could actually put some downward pressure, keeping it from rising substantially. That would be the environment where the Fed doesn't cut this year.